Hello everybody, my name's Tim Hughes. I'm the Director of Communications for Spirit Invest. Today it's my great pleasure to talk to Marc Wiese, who's the Managing Director of Orion Wealth Managers. Good morning, Marc.
Thanks, Tom.
So today's subject, we're going to talk about active versus passive asset management. I mean, it's an issue that has grown in public importance. It's very important in terms of the way Warwick approaches its asset management and its private wealth management. So let's try and unpack it and expand it a little bit more. So there's been a lot of ongoing discussion about in the market around active versus passive management. But what are your specific views as MD of Orion Wealth Managers?
Well, thanks, Tim, and thank you very much for watching this. I think the point around active versus passive has been a lot more topical of late. I think for a couple of different reasons. But if we may just pause and look at what is active management and what is passive management. So effectively, active asset management is where asset managers analyze underlying shares and buy those shares that they believe have higher intrinsic value or higher fair value for clients. And they would analyze all the various stocks depending on their style. Maybe it's a quant-driven style or valuation-driven style or momentum or quality or whatever it might be. But based upon their views, they believe the stock will outperform the market, and they would select those shares based upon their conviction. Whereas passive management effectively is buying all the shares in the relevant index. Now, there's several different indexes out there. In South Africa, we obviously know there's the likes of the JSE Aussie, Cap Swix, Top 40 internationally, and globally there are quite a few out there. Likes of the MSCI World, the S&P 500, and there's a lot more specific sectors as well, including bond or gold or resources or whatever it might be. But a passive strategy effectively buys all the various shares within that sector or instruments within that sector at the same percentages as the index. So effectively they're saying we'll buy everything out there that measures inside of the index. And those generally sit in what we call a ETF.
I was going to ask you that question. So it's an ETF, which stands for what?
Exchange Traded Fund.
Exchange Traded Fund. And this is an instrument for passive investing. It invests in a particular index in proportion.
Correct. So when clients invest into an active manager, generally it's via a unit trust. And effectively, an ETF is just a unit trust where they buy a specific index in those underlying instruments, and effectively buying the whole market compared to an active manager that tries to find the best stocks out there and selects only those.
That's interesting. So, I suppose most clients and people in the public, people watching this, want to know, well, what have been the results? Has there been a track record about passive investing versus active? Has there been a pattern internationally, and do we know what the results have been like in South Africa too?
Well, I think that the concept of active investing, certainly in South Africa and for South African clients, is still fairly new. We don't have long-term, the likes of 10, 20, 30-year track records on ETFs or passive managers specifically. But, I think if we do look at active versus passive, there'll be certain times when we expect active will outperform, and there'll be certain times when we expect passive will likely outperform. Now, no one's got the crystal ball and knows exactly which stocks are going to run or how the market's going to be positioned. But if we look at the past 5 years, and specifically looking at the global asset management side, looking at the ASISA global general equity sector, it's been quite a condensed sector where specifically the likes of the top 6 stocks in the S&P 500, which makes up, 1.2% of the S&P 500, makes up 35% of the overall allocation in the index. So you've got 1% of stocks making up more than a third of the underlying value. So if those stocks run, ultimately the market runs very hard, and obviously passive managers buying the whole market generally outperforms. And that's kind of been the picture over the past couple of years. If we look at the past 5 years, I think a scary stat is that only 6% of active managers beat the S&P 500 index, which means 94% underperformed. But I think it goes deeper than that. Obviously, when you buy an ETF, the reality is that ETF can never outperform the market. There's asset management fees, generally lower fees, but there's still fees, there's trading fees, etc. So globally, we've seen the passive management do quite well, and that's why we believe there is value in active and passive management for clients, depending on the market conditions. Looking more locally, obviously the market is quite a bit smaller. I think the asset managers in South Africa, we've got some really, really smart people and amazing analysts in the country. And more than a third of the local asset managers have been able to beat the JSE Aussie type funds out there. Those are the ETFs, but still been slanted towards quite a strange market, especially more recently with the likes of Naspers and gold running exceptionally hard. And I think it's a very big call for an asset manager globally to invest more than 35 to 40% of a client's portfolio in 1% of the index in terms of the number of stocks available in that index. Similarly, locally, buying the likes of gold and Naspers at an overweight market percentage is quite a big call to make for a lot of asset managers. So it's been slanted towards the passive side. I think if you look at longer term, things do kind of even out, and I think the expectation for the future is that the likes of active management, if you've got the ability to choose the right managers, certainly also holds value to clients.
Very interesting. So the picture has been one of huge concentration, in a number of stocks internationally and to some degree also in South Africa. So I think that the ETFs or the more passive side of things understandably has performed well, but there's of course risk in that concentration as well. So let's lead to, having looked at active and passive management, let's look at what your specific recommendations are. You've analysed what these phenomena are, but let's look at some of the specific recommendations, really trying to look at what clients need to know about active and passive management and how you go about your own wealth management at Warwick.
So I think it comes down to each client and what they're looking to achieve and their risk tolerance, which is always quite important. So I would recommend for any client to meet with a financial advisor and do an in-depth analysis rather than just investing in one sector or active passive only. I think a comprehensive financial plan is quite important. But I think realistically for our clients and as Orion, as well as Warwick Wealth being one of our affiliates, as well as Orion Investment Managers, the ability to choose the right type of active manager, I think, is exceptionally important, and not just one. If you buy 4 different active asset managers, all with the same style, they're likely to provide a similar result, and that kind of defeats the object in terms of diversification. So at Orion Investment Managers, being one of our partners and the various independent equity advisors that they utilize, we have several different styles, including the likes of value or quants or growth or momentum, and the ability to change between those styles, I think, is quite important. Internationally, I think really important to have different styles, but also active and passive. I think a blend between those often provides the best results for clients and also smooths the ride to some extent. But I think diversification for clients goes further than active and passive, and on the active side, further than just the likes of different investment styles, although those things are very, very important. But we believe taking an approach of a diversified approach for different asset allocation, including fixed income, local, global, property, bonds, floating rate notes, and within those diversifying between active and passive as well as different active styles. It just provides clients with a smoother ride generally. The last thing I would add in terms of diversifying clients, and obviously hedge funds is an active style, but I think traditional as well as alternative asset management certainly has a place. And combining the likes of active, passive, asset allocation, different sectors, different styles, as well as alternative and passive, generally provides a client with a very good position for the future.
Marc, it's been a very, very helpful analysis of active versus passive management, but it seems to me, given some of the challenges and the complexity, that the advice that you're providing is speak to a wealth specialist, speak to a credible, professional, well-qualified financial advisor, and look at your own sort of risk profile, risk analysis, and make decisions in terms of what your own specific requirements are as an investor. Is that what we're concluding?
Yeah, I think the market's changed. If you jump 10, 15 years back into the past, I think we had maybe 100 or 150, if that, different unit trusts out there. Passive management as well as a lot of alternatives weren't really available to a lot of clients. There was a lot fewer asset management styles available in the market. In some instances, I think the market was less volatile. So I think in today's market, having a qualified, experienced wealth specialist as well as a team that backs them, so I think one person on their own can't do everything, certainly has a lot of validity in today's world.
That's very, very helpful, Mark. So I think ultimately for our viewers, we would be looking to Orion Wealth Managers and Warwick specifically to provide that sort of qualified advice, professionally qualified advice. We hope that you found this video useful, as you, I'm sure, have done for the rest of the series of videos that have been conducted with Mark. And we look forward to updating with you next month. Thank you for watching.
Thank you.